news on our screens right now, Shagata. I'm sorry, I'll have to interfere you there and interrupt you. The May IIP is actually a lot better than all our expectations put together. It was expected to grow at just 0.4 of a percentage point. It's up 1.2%. So finally in the positive territory and handsomely so, if I may. Indranil Pal, let me let you have the first word in this. 1.2% for IIP. Still awaiting internals on that data, but does this anywhere reflect the picture on the ground? Is it a sigh of relief finally for New Delhi?
No, I think what Shagata was also trying to point out is that it's more a base effect came to a certain extent, and definitely we'll have to look at the internals, but I think capital goods is definitely not as negative as the last year. Obviously, the IIP could have been a lot better if the electricity production had been relatively on the higher side. That electricity production has had actually moved down quite significantly. So overall, I don't think it really changes the core trajectory or the trend path of the IIP. These are noises that could be above or below the trend path.
All right, manufacturing sector output is at 0.7% versus a contraction of over 3% on a month-on-month basis. So these are internals that are coming in. In fact, the June CPI inflation is also out, well within the comfort zone of the numbers that we had put out. It's at 5.77% versus our own poll of 5.79% and versus 5.76% in the previous month of May. Jayesh, let me come to you very quickly. CPI well within the range that we were talking about, 5.77%. IIP a lot better than was expected. The macros seem to be turning a corner here. I mean, I do understand it's largely on account of base effect for IIP, but we're still not looking at levels of contraction here.
Yeah, I think IIP definitely is more on the base effect, but at least CPI, even though it's come higher at 577, there were apprehension of, with some people and in the market of around 6%. So with 577 CPI, that would be taken very much in the stride. Of course, we may still have one more CPI coming up higher. And after that, we are moving downwards throughout. So I think 577 would be a good news for the market tomorrow. Having said that, on the IIP side, it is we still need to see the details. But as you said, manufacturing slightly up, which is kind of reflecting into the Q1 results to a minor situation.
It is indeed, and which is why there's plenty of hope that's building on the Q1 results, and many people expect the earnings revival to happen this quarter. But rural inflation, I'm going to take you through the internals. Just give me some more time here. CPI rural inflation is at 6.2% versus 6.4%. Manufacturing, like I've already said, is at 0.7% versus a contraction of over 3% that we'd seen in the previous month. Urban inflation is at 5.26% versus 4.89%. Vegetable prices, and I think that's an issue there, 14.74% versus 10.77% in the previous month of May. So vegetable and food continue to be the big Achilles heel as far as the government is concerned. Maithili, come in on that. I'm trying to get you internals. May capital goods output has shrunk by over 12.4%. So that's a shrinking that we're seeing in that notoriously volatile data, but that's the data for you, capital goods output. Maithili, come in on that, the internals that I've just outlined for you.
Well, let me start with a slightly more dismal news of capital goods, because we've seen contraction in capital goods right from the beginning of this calendar year, and that's not good news at all. If in the month of May again we have a contraction, that certainly is not good news. Granted, capital goods tend to be lumpy investments, so you could see sharp movements both up as well as down, but it still is not very happy news when right from the beginning for 5 consecutive months we find a decline in the capital goods output. As far as the CPI is concerned, again, it's not very good news when vegetable prices rise so much. The only positive silver lining that I may clutch at straws is that vegetables and fruits tend to be seasonal. So to that extent, one can hope that after the monsoons in the summer, hopefully vegetable prices will come down. So it's not so as worrisome as, say, pulses, where price rise tends to be more sustained and we have a genuine shortage. There is a structural deficit as far as pulses are concerned, whereas fruits and vegetables tends to be more seasonal. So I would say a little bit more comfort perhaps on the CPI front, not completely out of the woods as far as IIP is concerned. So better than before, but certainly nothing to celebrate or write home about.
Absolutely not. And Indraneel, I want to get you in on this. Some of the internal data is now out. So rural inflation is out, urban inflation is out, vegetable prices are out. Is the picture beginning to tell you a story about retail inflation? And is it also beginning to tell you a story about that 4% plus minus 2 is not perhaps a realistic target? We will have to look at higher levels.
I'm not sure how you possibly look at it, simply because there has been a lot of effort from the Reserve Bank of India in trying to get the inflation to a more sustainable zone, and therefore I'm not sure whether a 4 plus minus 2 target would be totally done away with. That's one part of it. The second part, of course, is the question that you asked about retail inflation. I think we have seen the overall urban inflation remaining on the relatively higher side, which is also sort of explained by the core inflation being on the higher side, and our bet is that that would possibly continue, because most of the services that we talk about within the urban side of the story, especially the healthcare, education, etc., continues to be in short supply in India. Which necessarily means that core would be more sticky. The jumpy element would be the vegetable prices, the pulses, which Maithili has clearly pointed out is the sticky element within the overall inflation trajectory, inflation basket. So my belief, therefore, is that we might sort of see come down of the inflation post the monsoon, with better harvest being expected, but continue to sort of flirt with the 5% level as per the current target of the Reserve Bank of India by around January to March level. So I'm not really seeing too much of a significant comfort in terms of inflation coming lower than the 5% levels by the time that the Reserve Bank is looking at.
Jayesh, let me get you in on that. There is a feeling that, the inflation target of 4 plus minus 2% is what was set by the Urjit Patel committee, and under the monetary policy targeting framework, it's very clear that the inflation target is for the government to decide, and then the operational details of how to get there, it's in the Reserve Bank of India's domain. There's been a lot of talk recently about whether this inflation target per se needs to be re-looked at, and whether the 4% target is a little unrealistic in the Indian conditions. What are your views on that? Because if you remember, during the time that Dr. Rangarajan was governor, he had said in India's tolerance limit is in the range of 5 to 6%. So has it moved down lower, 4%, or will the Indian population live with, say, 5%, in which case maybe there's a little bit more leeway for a slightly looser monetary policy?
So I think if you really look at it, right, it's more of semantic and how you place it, right? So at various forum, RBI did mention also that it's 4 plus or minus 2, and therefore even 5 or 5.5 is a quite comfortable zone. But then you don't want to be erring on the closer to the outer limit, and therefore you have this push-up target of 5 in 2017 and 4 by 2018. Now, but very clearly still they had a leeway of plus or minus 2. So the interpretation how you take it, right? So, and even right now all the talks which we are hearing about, maybe if the government in the new agreement set up a target of maybe 5 plus or minus 1, it's still one and the same. But the only difference is, okay, the midpoint which you need to achieve is more towards 5 rather than 4, because it's going to be 5 plus, or that's what the media reports talk about, is 5 plus or minus 1. So the outer range at 6 and even at 5.5, even with 4 plus or minus 2 or 5 plus or minus 1 does not really matter. But as we have heard from RBI on different sides, there have been talk about that even 5.5 is a comfortable zone as long as it's within the range. But because you want to do it sustainably, and therefore 2018 target was kind of 4%, it still remained 4% at this juncture. So let's see how the monetary policy, the new one, that's only the media report, that it might change, and it might change to maybe, at the most 5 plus or minus 1. So overall keeping not really keeping and targeting 4 kind of number.
Yes, it is really partly a question of semantics, but when you say 4 plus minus 2% and 5 plus minus 1%, it does make a difference in terms of perception. But Sugato, if you look at the numbers that we're seeing, particularly if you look at rural and urban inflation, clearly what we're seeing in the past few months is that rural inflation has been running ahead of urban inflation. This is partly because of the fact that in the rural basket, food is a much bigger item, and food inflation has been running higher. Now, how concerned would the government be, particularly in the run-up to number of important state elections, if rural inflation continues to run higher? Or do you think in that area the ball is largely in the government's court and you're not going to see much monetary action? Swagato?
You're completely right. I think this is an issue of major concern, not just from just a rural perspective. The fact that distribution networks, so one part is the high weight of food in the rural consumption basket. The second part is, from whatever we understand, I mean it's imperfect understanding, whatever we understand, distribution networks within intra-rural are really bad. I mean it's much easier to get food out from peripheral rural areas into urban areas than getting them from peripheral rural areas into deeper rural areas. So those issues, I mean rural connectivity, the things that the Prime Minister, Mr. Modi talks about, I mean the 6 pillars that he talks about in terms of increasing rural productivity. Increasing rural productivity is a very, very important part of lowering food prices, say for instance. So those issues need to be looked at. I mean, it's not just from an electoral perspective, which is very, very important from a political angle, and inflation is a highly political issue. So not just from that, from India's growth perspective, productivity perspective, I think this is a very, very key issue. And if you just permit 1 minute, a little diversion into the capital goods part, there's one part which is that wretched rubber cables. Which is, I mean, you know, last time it was 24%, minus 24%, of which minus the contribution of this cable was minus 36%, all the others added up to plus 10% or whatever. So I don't know why the CSO is not doing, and I think this is sampling error more than any actual output numbers, and I don't know why the CSO is not fixing this problem, which to my mind is distorting the capital goods segment. Sorry, I'm extremely sorry about that.
No, actually it's not just capital goods, and the CSO has been trying, because IIP, if you look at the IIP data, the base is still 0405, and that is the Indian structure of the Indian economy has changed so dramatically from 0405. You also have it in terms of volumes. But incidentally, given the fact that there are these inconsistencies in the IIP and the overall GDP numbers, should one get overly concerned about IIP, how it fares? Because if you look at whether it is core sector, the relationship between core sector growth and IIP, relationship between IIP and the GDP numbers and the GVA numbers, does it seem that the kind of concern we show every month when the IIP numbers come out, is that concern a little unwarranted, given that the IIP numbers are a very poor indication really of what the final growth is going to be? Last year, for instance, we saw manufacturing growth as per IIP at only 2.4%, but the GDP numbers finally came in at 9.5%. So is it a lot of, is it a waste of time and effort that we debate the IIP numbers so much when there's really very little clue to what's really happening in the economy based on the IIP numbers? Indranil?
Possibly you're right. At this point in time, it could be a waste of time. But I am expecting that it might not be a continuous waste of time, simply because we are looking forward to the government to provide us with a new based and new sample oriented IIP, which in my opinion should be representative of more the actual on the ground production elements within the system, which will possibly sort of lead you onto the GDP data. And even though there can be still inconsistencies between the IIP and the GDP, given the fact that the GDP is now or the GVA now is more a number which is based on valuation rather than volumes, which is the IIP. There can still be inconsistencies, but at least I am hoping that the direction of the change of both the IIP and the GDP or the GVA should be matching. So we would definitely therefore be waiting for the new IIP series to come out. I am not sure when that is going to come out. For a better understanding of the production elements within the system, to take a better view on the overall GDP or the growth numbers of the economy.
Fair point indeed, overall growth numbers of the economy. But Maithri, I want to throw this question to you. If you actually look at the internals of inflation, this should be causing a lot of worry here in North Block and at least power corridors in New Delhi. I mean, food prices are substantially higher, vegetable prices are nearly touching that 15% mark. What are you making of, how do you think the government is going to read into these numbers? Because increasingly, the more people that you meet in the government, of course, after the regime change in RBI or the impending regime change, more and more people want to focus on WPI, and people are not willing to talk on CPI. So much so that, Piyush Goyal on record said yesterday it's the WPI that needs to be focused on by the next RBI governor and not CPI. How do you believe the government is reading into the CPI data, and how differently is the RBI going to read into this?
Well, that would be a very unfortunate Supriya, if it were to happen, simply for the reason that I think in India it's very difficult to take a view based on a single number, and having shifted to the CPI to kind of do a flip-flop would be very bad. So even earlier when the RBI was looking at WPI, they never looked only at WPI, though they never made this explicit. They look at a whole range of indicators. So likewise, even now, I think the RBI, though its primary focus was much more on CPI than under the earlier regime when its primary focus was the WPI. So here this RBI became formally an inflation targeter. So it was looking perhaps almost 90% of its focus was on CPI, but they were not indifferent to what was happening to WPI. And I think the worst thing for policy to happen, flip-flops in policy are very bad. So even as the government looks at CPI and also looks at WPI, what is necessary is that you don't lose focus and just look only at WPI or only at CPI. What you need to do is take a more holistic view. And as far as the food economy is concerned, there I think is an area where monetary policy has very limited role to play. Management of the food economy is essentially within the government's domain. And here, as I said, vegetable prices tend to be seasonal. And every summer in the monsoons, because the balance in India is so fine, any slight disruption in supply, immediately you see prices go up. So whether it's onions or potatoes, so we've seen that year after year. So I wouldn't worry so much about vegetables. As far as pulses are concerned, we have a structural problem. The government has been trying, and as far as MSP is concerned, they have been trying even in terms of procurement and in terms of announcing an MSP for pulses. The focus is much more than before. But these will not yield dividends in the short run. So as far as the food economy is concerned, the ball is firmly in the government's court. It can be managed, provided the government acts and acts proactively. So as of now, I think I wouldn't worry too much. It would be a serious mistake if the government shifted focus completely away from CPI and moved towards WPI. What you need to do is keep one eye on the WPI, one eye on CPI, and then kind of move ahead from there. Would you agree with that, Jayesh?
Absolutely. Like if you really look at it, earlier also we had a rate hike when WPI didn't move, but CPI moved, but the target rate was WPI, and therefore when the divergence widens, there is always a look at the other indicators too. And so I completely agree. There's no point getting flip-flop back to WPI or anything. But yes, if the divergence between WPI and CPI widens a lot, there has to be some weightage to be given to WPI too. And that's the way to go forward.
Shogata, one of the disappointments that we've seen is that the MPC composition is still not been declared, and we have the August monetary policy not very far away. So what is holding the government back? Is there some likely disagreement that we have not seen really under the under the radar, as it were, between the RBI and the government? They're supposed to be, the government's nominees are supposed to be appointed by an independent panel. What is really holding the government back in declaring who are its members? Because as far as the RBI's nominees are concerned, it's very clear. It is the governor, it is the deputy governor in charge of monetary policy, and the executive director. So it's in government's nominees where the government seems to be very shy of coming out and saying who are its nominees. So what is one to expect, because you have a situation where you don't have a monetary policy PC in place, and the governor is essentially now a lame duck governor for all practical purposes. So what kind of monetary policy can we expect in August?
Offer a half intelligent answer to this. I mean, but I'm probably as much in the dark as anybody else on what is going on with the selection of the policy. So I think the next policy too will be a governor-led policy, probably his last policy before he demits office. As to the deputy governors, it's not deputy governor in charge of monetary policy. It's just deputy governor. It can be any of the deputy governors. So any officer, not necessarily a monetary policy MPD officer. It can be any officer of the RBI above a certain level, above a certain range. So, I mean, given this, I mean, again, I mean, the selection, the permutations and combinations that the government has in mind, I don't even know who the selection panel is for the MPC. So let's wait and watch.
It's a wait and watch indeed, not just for the MPC composition, but also for the top man at the RBI. And so I'm a little amused with what's really happening as far as that entire monetary policy is concerned. In fact, we all went with the story. This is Governor Rajan's last and RBI's last. There's going to be a monetary policy committee. But if data were to strictly drive policy, and Indraneel Pan, I'm going to throw this to you. What do you expect to happen on the 9th of August? Because this is largely going to be a governor-led policy. It's not going to be a monetary policy committee in any case.
I think very clearly I would continue to hold on to our own expectation that there is no change, simply because as you go into the August policy, the maximum data that you would have at this point in time is the June CPI inflation, which has at best been a little bit on the higher side than even the previous number, and the first quarter average is definitely higher than what the RBI was anticipating, which was at around 5.3% for the quarter. So from the perspective of sort of reading inflation through a CPI and the very fact that we would enter into a zone where the 7th pay commission would be awarded, we would also sort of be looking forward to relatively higher consumption, because we are expecting rural demand to be on the higher side. Unless you get sudden sharp drops in inflation from, say, vegetable prices or pulses prices coming down, as I earlier explained, I am not really clear about how close or how confidently we can get below the 5% mark or whereabouts by around January to March 2017. So in terms of the overall direction of monetary policy, it still remains a status quo and unlikely to change very significantly unless you have significant deviations from the trend so far as the CPI inflation is concerned.
Fair point indeed. Jayesh, we'll let you quickly have the last word on this. There's one way the North Block is going to read into it. There's quite another that Mint Street will read into it. But how should markets read into this data? They've been up for a while because of global cues. They've also been up for a while expecting an earnings revival. Does the data suggest and corroborate that story on the ground?
No, so I think IIP data, of course, is still not that good to cheer it up, but it's purely liquidity-driven, global liquidity-driven situation. And as far as bonds are concerned, even though the number 577 is kind of was expected, we may have one more high inflation coming, and hopefully the next inflation after that should start tapering down. But more importantly, again, that's the local liquidity which we are seeing since last 10 days, last fortnight. That is what is really driving the local bond market, and hopefully that liquidity would, if it continues, that can have a much deeper impact than the rate cut, whether it happens in August or not.
That's a rather balanced and sane view coming there. But thank you very much, each one of you, for being with us. Indraneel Pan, Shaukat Bhattacharya, Jayesh Mehta and Maithili Basnurmat. We wrap it up on this edition of News First. The twin data is out. It isn't looking like the most rosy picture that could have come out, but it's definitely better than last time around. Inflation is on a tight leash and IIP is finally in the positive territory with growths of 1.2%. Thank you very much for watching this show. Up next is going to be News First at 6 p.m.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.